I think it's interesting that this kind of volatility, these kind of declines happen so frequently. But every time it happens, there is this reaction within headlines, within how investors react. And it's not a bad thing. It's not a criticism of how the media reacts. I just think it's an inherent part of investing that these declines, no matter how frequent they are, even if the kind of declines that we've had in the last month is the kind of thing that we've had 3 or 4 times a year, going back forever, it's still going to feel way worse than it should when it happens. And I always say, the Dow fell, 1,000 points last week, which is the first time it's happened since the last 1,000-point decline that you don't remember anymore.
Yeah.
These kind of things happen all the time. And I think the proper framing for big volatility like this is, there's a cost of admission for big market returns. If you want big returns over the long term, those don't come for free. You have to pay a price to get those. And the cost of admission for markets is, of course, volatility. And there's 2 ways to look at that. You can look at it as a fee or a fine. A fee is you're paying the cost of admission, and it's a good trade. You're paying the cost, but you're getting something great in return. A fine is you're not supposed to pay that. You're not supposed to get fined. You're supposed to avoid fines, so you try to avoid it. And I think viewing volatility as a fee instead of a fine is the proper way to think about it. This is the cost that you're paying to do really well over time. But it's not a fine. You're not in trouble. You didn't do anything wrong. You don't have to avoid this. You don't have to feel guilty for dealing with this volatility. It's not a fine. It's just a fee that you're paying. You're just getting the bill. You're getting your quarterly bill to get long-term returns over time. That's what these volatility kind of spikes that we deal with every quarter, I think, mean for investors.